136 now. So I think last class there was 180. I'm not very sure if everyone would join. So we'll wait for a few minutes and then let's start. So until that, can you all please rename yourselves with your registration numbers, right? Because only then we can easily track and mark your attendance. Otherwise, it's too hard to mark your attendance, right? So please rename yourselves BYC, maybe space, your number, 21, and whatever your number, and your name, right? So then we can easily track you all there, right? So others, if you all want to know how to rename, you'll have to click on there is a icon saying people, right? So click on that people thing there, right? Go to that, you will see your name right on top. Click on that small arrow like thing, drop down, and you can say edit your name and email. So click on edit your name and email, type in your name as BYC, your number and your name, right? So type it that way, and I think then it should be fine. Okay, anyone okay? Anyone with issues there, right? So if you all have renamed yourself, it's fine, should be okay. Okay, so we'll start. Yeah, I think we are already late. I don't usually like getting late. Okay, we're 10 minutes late, but so we'll start. I'll anyway finish all the MCQs today, right? 20 unit number 1. Okay, so we'll just to remind you all where we are, if in case someone is lost, someone is wondering what are we doing today. We started with the MCQs for unit number 1, right? We did the MCQs for 2011, right? We did so behind every MCQ I explained the story behind it. What is the working, how does this come, what is the theory, and then I said if the same theory is being tested in a next question, I will not repeat the theory again, right? So I'm hoping you all remember what we did last class, right? That is why it's compulsory for you all not to miss a class, because sometimes now again if this theory is being tested, I will not spend time teaching the theory behind that all over again, right? So we went through 2011, right? I'm hoping you all have jotted points down and you all have written as well. I shared screenshots on the group, right? So today also, if someone is, you're really listening, while I explain, please try to maybe take a few screenshots once I have done writing. And then I have opened the group for everyone to send messages. You all can send it on the group. So we did 2011, right? We did 2012. We did 13 as well. And then did we do 14? No, right? I think we did only 3 years. Do we have to do 14? Yeah, right? Anyone just to reconfirm, should I start with 2014 or did I do 14? I didn't do 14, right? I have to start with 2014? Yes. Yeah. Okay, so we'll start with 2014 and then we'll today I'll be going a bit faster because I explained most of the theory last class, and then we'll go on. Okay, right. So starting with this 2014. Okay, 2014. So I want you all also to give me answers, right? So hoping you all also did do the questions once I asked you to. So we'll start with this, right? 2014 question number 1 is, economics is the study of scarcity of resources and full employment, scarcity of resources and production, scarcity of resources and choice, scarcity of resources and efficiency, scarcity of resources and substitutability. Now everything looks right. Okay, now what you have to figure out is, why is there something called economics in the first place, right? What did I say? What was the central problem of economics? Remember I said there was something called scarcity, the central problem. Yeah, color cannot be seen. Okay, so remember there was that, right? The central problem of economics. So the central problem, right? The central problem of economics was what? The central problem of economics was scarcity. Now, because we had scarcity, because our resources were scarce, that is why we had to make a choice, right? So what was economics about? Economics was about, right, the scarcity of resources, and because of the scarcity, right, because we only have a very limited amount of resources, we have to make a choice. We can't do everything. We only have, remember last class when I explained choice and all of that, I talked about a plot of land. I said that a person has only one plot of land. With that plot of land, he can't do a lot of things. He had to make a choice, right? So economics, in simple terms, is a study about the scarcity of resources and choice. This is what economics is. Number three, right? So some of you all said scarcity and full employment. Yes, full employment is there. We study about full employment also in economics, but that is not really what economics is. Economics is about, because of scarce resources, how do we make a choice and how do we really use these resources properly, right? So answer number three there for question number one. Okay. So production, why doesn't it come as an answer? Production, yes, production can also be an answer, but when we always have a better option, right? Now, what you have to figure out is, why do we have a subject like economics? We have a subject like economics because of scarcity. Now, because of scarcity, what should we do? Because of resources are scarce, right? We have to make a choice. So that is what really economics is, right? Not full employment, not production. Yes. Now, others don't sound wrong, right? Production also is involved in economics. Full employment is also there in economics. But what is the meaning, or why do we really have something called economics? Is because of scarcity, and that scarcity leads us to making a choice, right? So number three there. Yeah, that's an easy one. Don't overthink as well. Okay, another very easy question. Opportunity cost in economics is defined as, I explained what opportunity cost is last class. What is opportunity cost? The other opportunities sacrificed for obtaining something, financial cost of obtaining something, cost of time of obtaining something. Then there is total fixed cost and variable cost of obtaining something, value of the best alternative, sacrificed. So that's an easy one, right? That comes from your definition. I know most of you all know the definition. When you say opportunity cost, all of you all will say the value of the next best alternative, right? So it's a pretty direct question there. So question number two, answer is number five, right? Answer number five here. Okay, so easy one there. We'll get along with the other questions. Okay, nice. Economic good. Remember, I explained something called economic good. Guys, if you can't hear me, you have to connect to audio. I don't think you can hear me now also. Guys, others can hear me, right? No issue with that. Okay, so, okay. For those, I also can't remember. You have to go to camera and audio, and then you have to connect your audio. I'm hoping, okay, maybe the technical guys should be able to help out. Yeah. Okay. So out of the following, choose the correct answer that shows the correct features of an economic good. Remember last class I explained something called an economic good. I said an economic good is produced using economic resources, right? So it is produced using economic resources. Using, what are the economic resources to produce an economic good? Okay, difference between economic good and economic resources. So what are economic resources, right? Economic resources are these, right? Economic resources are land, labor, capital, right? And entrepreneurship, right? These are the economic resources. So using these economic resources, right? Using these economic resources, we are able to produce, right? We are able to produce economic goods. So economic goods can be anything, right? Economic goods. For example, economic goods, I can say cars, I can say, let's say tables, I can say pens, I can say anything, right? Anything that is produced using economic resources are called economic goods. Now, what you have to figure out is that these economic resources, right? I am recording. No one. Okay. So economic resources, right? These economic resources are used to produce these economic goods. Now, what you have to figure out that these economic resources, the land, labor, capital, entrepreneurship, these resources are scarce, right? When these resources are scarce, right? When these resources are scarce, right? They will generate an opportunity cost. Remember in my example, when I explained last class, when I talked about a plot of land, right? I said I only have limited amount of land. The land is scarce. So therefore I had to make a choice with this land, what am I going to produce? What economic good I'm going to produce? When I decided what economic good I'm going to produce, I had to make a choice, and there was opportunity cost. So remember, when we talk about economic goods, one thing that you all have to definitely remember is that there is an opportunity cost, right? So this is for sure. Sorry, not number two. Existence of opportunity cost, for sure it is going to happen, right? Then you have number one, right? The existence of production cost. Now, there is obviously, right, economic goods does not fall from earth, right? Now, for a car, for a table, for a pen, right, anything, you have to involve a production cost. When you, let's say, employ these economic resources, the land, labor, capital, entrepreneurship, right? When you use these economic resources, you will not get it for free. You have to pay a return. Remember, for land, we say the return is rent. For labor, we say wages. For capital, we say interest. For entrepreneurship, we say profit or a loss. So there is a return. There is a production cost involved. So A is also a feature of this. Then the question comes here, right? Now, most of you all know that this does not count the existence of decreasing marginal cost. No, you will actually have increasing marginal cost, not this. Then it's here that you all have a question, right? Most of you all are this thing over here. Okay, give me a second. There is one student who can't really hear. Okay, what can I do? Wait, I'll just check. Okay, so right then, does economic good, what do you all think, is this a feature or not? C, consumer has to bear a cost. Is it a feature or not? C, what do you all think? Yes or no? 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 How sure? Yes? Not sure? Okay, so what happens here is this, right? Think of the government textbooks that you all get, right? The government textbooks that you all get, you're the consumer. Exactly. You are the consumer of the government textbook, right? So government textbook, right? Government textbook until for O levels you all got, right? Now these government textbooks were economic goods, no? They were produced using scarce resources. They were produced using land, labor, capital, entrepreneurship. So the government textbook was an economic good, but you were the consumer of that good. Did you pay a cost for that? No, right? So consumer has to pay a cost is not a feature of this. It does not always happen. Sometimes, yes, generally the consumer has to pay a cost, but not always. Consumer does not have to always pay a cost. So it's not a feature of an economic good. So government textbook, right, is free to the consumer, right? So free to the consumer. Is the consumer bearing a cost? No. That is where a lot of students, they miss the point here. So what you'll have to remember, economic goods, this is not a feature, right? The consumer has to bear a cost is not really a feature of an economic good. Let me try to draw a nicer box. Okay. So this is not really a feature of that. So C is also not a feature. You all can eliminate C as well. So then the answer would be A and B, number one, right? I'm hoping you all did understand that part. Okay, how does increasing marginal opportunity cost, increasing marginal cost? Now, increasing marginal cost, right? Increasing marginal cost comes with opportunity cost, right? Remember, you have something called, remember when we study unit number one, when we study a PPC, right? We say the more practical story is that opportunity cost increases every time you produce a good, right? There is increasing opportunity cost. Increasing opportunity cost, in other words, you can also call it increasing marginal cost. Marginal cost means each additional unit, the number of goods. When you keep on increasing the amount of goods, right, the cost that you have to pay increases. So in terms of, now it is not money cost, right? We're talking about opportunity cost here. Every time you increase the production of a good, right, every time you increase economic goods, right, if you all know the PPC, every time to increase the production of one good, the amount of the other good that you have to forego keeps on increasing, right? So that is why there is increasing marginal cost, not decreasing marginal cost. Consumer has to bear a cost while purchasing economic good. Yes, consumer has to bear a cost, but not always. That is what I said, the government textbook, right? It's free to the consumer. So that does not make it a feature. To for something to be a feature of that thing, it has to be that always when you have this, it should be the case, right? So that is why, exactly, street lights, another good example. So street lights, the government is, there is a cost for the government, right? Government is having land, labor, capital, entrepreneurship is involved there. But are you paying a cost for street lights? No. So that is not what this means. Is that free good include economic good? No, a free good and economic good is not the same. Free goods, what were the examples? Don't confuse the two. When we say economic goods are the goods that we produce using economic resources, using the scarce resources. Free goods are things that is available in unlimited supply. Things like, let's say, free good does not mean consumer gets for free. The definition for free good is that there is unlimited supply. Example, sunlight. Example, air. Example, let's say, rain, water. That is what free goods are. Don't confuse free goods with this. Yeah, exactly. That is that. Uh, so for street light, are we considering increasing marginal cost? Street light, yeah, street light also you can, right? For street light, now even every time the government is going to increase the amount of street lights, they have to take money from something else. They have to forego something else. So whenever there is an economic good, there is increasing opportunity cost or increasing marginal cost for sure. That is why A and B is the answer here, right? Towards a feature means through this you should be able to recognize this. Now, consumer has to bear a cost. That does not mean it's an economic good. For example, textbooks, the street light, like you all said, right? You get it for free. That is also an economic good. So, consumer has to bear a cost is not really a feature. Remember that. Okay, it's features 1 and 2, production cost, and there is an opportunity cost. Hope that part is fine. So then going to the next question. Okay, this is another good one. The functions of a price in a market economy, commonly tested question. Okay, functions of a price in a market economy. You have rationing, functioning as a store of value, da, da, da. Remember, there are three functions, right? Price in a market economy, it generally has three functions, right? So functions of price, right? Functions of price in a market economy. You have to remember there are three functions. Number one is the signaling function, right? The signaling, or in other words, you can call this the informative function. That, what does this mean? Signaling function or the informative function means that the price gives you signals, it gives you information. For example, let's say if the price of a product is very high, what does that tell you? That tells you, that gives you some information saying that this good is scarce, that there is excess demand for this good, more people want to buy it compared to the supply, right? So that is why you say function of price. When you say function, when you say signaling function or informative function, means that this gives you some sort of information. Price is too low means this gives information to the let's say the producer or the supplier, saying maybe there is excess supply of this good, right? That is what that means. Okay, another person can't hear me. Hope it's fine. Okay, so that is the first function. Then what is the second function of price? Second function is that it's the incentive function, right? The incentive function, right? So what is the incentive function? Incentive function is that it motivates you. Now, for example, if the price is high, it motivates the producer to come and supply more. If the price is low, it motivates the consumer to come and buy more. It gives you an incentive. Incentive means motivation, right? And then you have the third function that is called the rationing function. Rationing function, another word for this is the allocative function, right? So know the other words as well, because they can give you sometimes with the other word, right? So rationing or allocative means, for example, if a good is scarce. Now, for example, now why do you think? Remember cricket match tickets, right? A normal cricket match ticket, let's say you can buy for 500 or 300, but when it's a World Cup match, right, the ticket price is high. Why is that? Because they are trying to allocate, because World Cup, there is so much of demand. Everyone wants to come and buy and watch the World Cup. So what are they doing? They are increasing the price so that they can allocate the limited amount of seats to the people who want to buy. If they give the World Cup ticket at, let's say, 300, there will be too much of demand. There will be an excess demand situation. You will not be able to allocate, or you will not be able to ration the demand and the supply. So what do? You increase the price, right? So the 300 ticket, same thing, right? The stadium is the same, lights are the same, everything is the same. What do? You increase the price, you make it 1500. That way you are able to allocate this amount of seats that you have, right? You only have a limited amount of seats in the thing. So that is what we talk about functions of price. What about the three types of incentive functions? You don't have to go into that deep. If you just have in this basic, I think it's more than enough, right? Function of price. This also they have not asked to explain. They usually ask in MCQ. If they ask in the second part, they ask you just to name the three functions. That is all they ask, right? So according to that, the answer here is the fifth one, right? That gives you signaling, this and this. Guys, those people have connection problems. I really don't know what I can do, right? So I'm also trying my best, trying to give this. I understand there are some people saying it's thundering, some people are saying they left and they joined back, right? So connection issues, guys. Now while I'm teaching, I can't pause and I can't try to solve your audio issues and all of that. So what you all can do is maybe drop a text to Huck, who usually tries and solves the issues there. So try to do that, or else I really don't know, guys. I'm really sorry. Okay, explain the signaling function again. So signaling function, or in other words, the informative function. This is where the price gives you some sort of information. Now, for example, if the price of a good is high, right? If you all remember, now you all need a bit of, you need two knowledge here, right? So if the price of a good, let's say you have a demand curve, you have a supply curve, right? Let's say the price is at this range, right? The price of a good is high. What does that signal you? When the price of a good is high, it says what? It says that there can be, right? There is a excess demand. Sorry, not an excess demand. Price of a good is high means, right? What do you really think is the issue? Now, for example, okay, forget about this demand curve. Okay, diamonds. Now, why is the price of diamonds high? Right? Why is the price of diamonds? Why do you think it's high? Oh, what does that tell you? The price of diamonds are high means it gives you some information saying that these goods are scarce. They really don't have, you really don't have enough resources. Exactly. The supply is low. When the price of, let's say, something is very cheap, right? That gives you information saying, okay, there is so much fellows coming and supplying this right now. So the price gives you some sort of information. Okay, for those with connection issues, guys, okay, anyone with, let me type a message here, right? So just go through. Guys, if any of y'all also who can hear me right now has connection issues, there is no point really telling me, because right now I am not going to stop the class and just try to connect that issue. So just check with Huck. If he can do something, he will try to set up your audio or something. If not, maybe there is some connection issue on your end, right? So anyone with, give me a second, let me type this message. Please contact Huck. Right, so he's also traveling, he's on his way to Gaul, so he'll also see what he can do. If he can help you out, he will, but if not, that is the thing, right? So I'm hoping this part is okay. Don't overthink this, guys, because I'm telling you, this is not a question that that y'all would they would ask for in detail. They will not ask you to explain this. Okay, type the definitions. Okay, I'll I'll send you the definitions maybe after the class. Maybe can you just drop a text? I'll not waste time because this is not something they will ask you to. They will not ask you to define or explain in detail much, right? Again, I will be covering this when we do, let's say, a few part 2 questions. Okay, right. This one, okay, another good one. In a market economy, personal income is determined by personal income, government factor price policy and subsidies, factor price in the factor market and personal income taxes, factor price in the factor market and government wage policy, factor price in the factor market and the quantity exchanged, property ownership and the factor price. What do you all think? It's a good question. This comes, where does this question come from? This question stems from here. In a market economy, right? If you look at the question, what? How to, sorry, not how to produce, whom to produce, right? So whom to produce, what did whom to produce means? What does whom to produce means? Whom to produce means who will get the output, who will get the goods that has been produced, right? That is what whom to produce means. So then in a market economy, who will get the outputs will depend on that person's personal income. Whoever who has more money is able to get more of the goods, right? That is what it meant, right? So personal income will depend on what? Then they are asking this in a market. Okay, if you are confused, where does this question, where do they ask this question from, or where is this question really coming from, right? Where is this coming from? This question is saying market economy, right? In a market economy, when you talk about whom to produce, what is whom to produce? Now for this you need your basic 3 questions, right? You have what to produce, right? You have what to produce, you have how to produce, and then you have, right, whom to produce. Now what does this whom to produce mean? That is what I'm trying to explain now. Produce means, in simple terms, who gets the goods that are produced, right? So who get the goods that are produced, right? Now they have a market economy will first decide what goods are they going to produce. Let's say, are they going to produce, let's say, bread or buns? Then they will decide how are they going to produce. Are we going to use capital or are we going to use labor? Second question answered. Then third question that they would answer is, right, we have decided what to produce, we have now selected the method and we have finished producing it. Now we have to figure out, okay, whom are we going to give these goods to? That is what we mean whom to produce. Whom to produce means who gets the goods. I'll be talking about this in detail when I do the part 2 questions, right? So don't worry about that. So then in a market economy, whom to produce will depend on one thing, will depend on the personal income. In simple terms, how much of income a person has. If a person has a lot of income, he is able to get a lot of goods that has been produced in the market. If he only has a very little income, he is able to get only a very little amount of goods that is produced in the market. So then what does his personal income depend on? What do you all think? Okay, how does my income depend on? What do you think is an answer there? A person's income is dependent on what? Okay, now your father is earning 100,000 a month. How does that depend on? Okay, sales. What else? What do you all think? Right? So it will depend on, let's say, your personal income, right? A person's personal income will depend on this, right? It will depend on how much of factors he owns, right? What is the property ownership? How many factors of production, right? How many factors of production does a person own? For example, now some people, right? Now some of your parents, they must be working, right? And also maybe you have a house that you have given on rent. So then what happens? When you are working, when your parents are working, they are supplying labor. That is one factor of production that they own. When they have given, let's say, a thing on rent, that is another factor of production. So first one, it will depend on the number of factors of production, right? And then will depend on what is the price for that factor, right? So for example, let's say your family, right? Let's say only your father is working. Let's say your mother is not working, only your father is working. So you have one, okay. Oops, give me a second. Where was I here? Okay. So let's say only your father is working, right? So if that is the case, right, you will have one labor. Okay, this is annoying. Give me a second. Okay. So we'll say it's only your father who is working, right? So you have one factor of labor, one labor, and let's say you have also given a house on rent. You have given something somewhere else. So that is one unit of capital, right? You have one unit of labor, you own one unit of capital. So for that amount of labor, let's say your father is getting a salary of, let's say, for that labor, right? That labor he is giving, and for that house that you all have given on rent, you all are getting a return, right? So for the labor, let's say he's getting earning 100,000 a month. For the capital, let's say you all are given a house on rent, or maybe part of your house on rent. For that, let's say you all are earning 25,000 a month. So then, how do you figure out, right? So this, in other words, is the price paid, or in other words, the factor price. What is the price? So how do I calculate my income then? To calculate my income, I have to multiply. Let's say, okay, we'll say both of your parents are working. We'll make it that way. Both of your parents are working. One parent was earning 100,000. So how do you calculate the total income of your family, or your personal income, right? So how do you get that? You have to multiply, right? So 2 into 100,000. So you're getting 200,000 by this factor. 1 into 25,000, you're getting 25,000 here. So in total, your factor income is 250,000. So that is how you calculate a person's personal income, right? Now, personal income is dependent on how much of factors of production you own and what is the price that you pay for that factor of production. Okay. If you consider market economy, the first three options will get eliminated. Okay, I'll talk about that. Did you all get that part? Yes or no? I know it's a little, it's not a basic theory. You all have to have some sort of understanding to understand this. Sorry, 225,000. Thank you for correcting me. Okay, so this has to be 225,000. Okay, if I want to repeat this, right? So I will be talking about factor income in detail, right? But just for now, just to give you all a basic understanding once again, right? In a market economy, to decide whom to produce. Whom to produce means who gets the goods. In a market economy, they will give it to anyone who has the purchasing power. In simple terms, anyone who has the money to buy. If anyone has the money, he can go and get the goods that is there in the market economy. So the money, in other words, his personal income. So if he has more income, he can get more goods. If he has less income, he'll be only able to get less amount of goods. So what does a person's income depend on? A person's income will depend on how much of factors of production he has, the ownership, how much factors of production he owns. Now, for example, let's say my monthly income. Now, the only thing that I am doing right now is, let's say, teaching. So my monthly income will depend on teaching. I have one factor of production, that is my labor, right? I don't have any, I'm not providing any entrepreneurial services. I'm not providing any capital or anything to anyone. So I only have a labor, right? For that labor, what is the price I'm getting, right? So then 1 multiplied by, let's say, whatever the price, let's say for my labor, for my effort, I'm getting, let's say, 20,000 a month. So that will be my personal income. So a person's personal income will be dependent on these factors. How many factors of production does a person own? In other words, the property ownership, right, will depend on this. And then it will depend on what is the price that they pay for that factor. Sometimes you can have, let's say, 100 land, right, 100 houses, but let's say they are not paying for those houses, there is no demand for those houses. Then even though you own 100, will you have any income? No. So it's not just the amount of property that you own, it's also what is the price that they pay for the property. Let's say you have 5 houses, right? 5 houses, you one house you have given for rent at 50,000. So 5 into 50,000, your personal income is 250,000. So your personal income, right, will be dependent on how much of factors of production you own and what is the factor price. So the answer there is the fifth one, right? The fourth one looks very close. I'll eliminate the other answers also, right? First one, government factor policies and subsidies. Remember, there will not be government in a market economy, right? Market economy is purely private, so you can eliminate that. Second one says factor price in the factor market and personal income taxes. They're not talking about ownership, no, right? Maybe for if you have a house, your factor price is, let's say, 100,000 factor price, but your personal income will not depend on what is the price. It will depend on how many factors you have as well, right? It will depend on your property ownership. I have this much of factors, and what is the price for one factor. Okay, what is subsidy? Subsidies is where we'll talk about this in unit number 3, right? So I'm hoping you all have done unit number 3 in school or somewhere, right? So subsidies is where the government gives you every time you produce something. It's the opposite of taxes. The government gives you some amount, right? That is what subsidies mean. Okay, voice isn't audible. Voice isn't audible. That is why I said you have to check it. Okay, give me a second. Right. So then it's not the first one. It's not the second one. Just your factor price is not going to help. You have to look at how many factors you have as well. Factor price in the factor market, government page policy. Not really. You can't go into government. Uh, Fifth question. Are you? What is the answer? The fourth one, no, right? This is 2000. Okay, what is the answer? This one says. Sorry, did I confuse that? Are they saying the fourth one? Okay, factor price in the factor market, quantity exchange at that price. Okay, I'm also confused. Give me a second. You're sure the answer says the fourth, no? This is 2013, 2013 or 2014? No, 14, no? 2014? Okay, so, okay, I think I made a mistake there. But my explanation is not wrong, guys. The explanation is the correct thing. It's just the wording. Okay, so it says the fourth one. Sorry. So then, okay, let me erase this. Okay, sorry for that. How do I erase this? Okay, I can't erase this. Okay, let's keep that there. Okay, not this. Okay, so I'll eliminate the other answers, then we'll see what is. That's why I said fourth and fifth is very close. So it's definitely not 1, 2, and 3, right? 1, 2, and 3 is definitely gone. Then you look at okay, number 4 says the factor price in the factor market. Okay, the factor price and the quantity exchanged at that price. Okay, looks right. So quantity is how much you own, and then again property ownership and the factor price in the factor market. Okay, both look very correct. I'll check with the original thing as well. Your past paper book says number 4, right? So we'll stick to number 4. Then I'll recheck this with the original marking scheme, what the thing is issued. If they have given marks for both 4 and 5, I'm not very sure. I think they could have given marks for both 4 and 5, but we'll see. Factor price in the factor market, quantity exchange at that price, property ownership, and factor price in the factor market. Okay, so okay, Azan. So we'll take a 2-minute break and then start. Give me a second. Okay, take a break for the Azan and we'll start. Mhm. Class will finish by 7. Mm, okay, right, guys. Is the azan overdone? Yes, all those. Okay, so just checking, right? I think, okay, I'm not very sure, right? So the past paper book would have said number 4, but I'm pretty sure when they were marking, they would have given marks for both 4 and 5, right? Because both 4 and 5, it makes sense. So we'll go with number 4, right? It says factor price in the factor market, right? So factor price, both that is there. The only difference here is they talk about the quantity exchange, here they talk about the property ownership. In other words, you are able to exchange the quantity of how much you own. Okay, so maybe I can say the factor market means where you buy and sell factors of production, where they buy and sell, let's say, labor, where they buy and sell, let's say, capital, right? That is where we have the factor market. Okay, so we'll go with 4. I can argue it based on this then. Why is the fourth one better? So it's like this. So they say, okay, fifth one I'll eliminate, right? What I explained. I'll just go one step ahead. Right. It is how much of property you have and what is the price they pay for that as well. But what if that property you are not willing to exchange? Let's say you have 5 houses with you, but you are only willing to give 4 houses to rent. So then it's not only your ownership, no, it is yes, based on how much you own only you can exchange. So maybe that is why they go give the answer as number 4, the quantity exchange, rather than saying the property ownership. If they can say the quantity exchange, that would be a better word. That is why I think they are going with number 4. But I don't think to your level you all have to think that deep. So the answer will be number 4, right? My explanation still remains the same. I'm just adding one more to this explanation is that let's say you have 2 houses, but you are not willing to, let's say, give one house in rent. Okay, so you're not willing to give one house in rent. You're only giving one house. You're only exchanging one house. So therefore, fourth one becomes a better answer there, right? So we'll go with that. Is that part okay? Yes. Fine. Yes. Questions, right? Don't think too much. Just understand it basically. I'll talk about this in more detail, right? So we have to hurry up a little. Okay, Azan is now on. Okay, we'll see. Okay, easy one. A point inside the PPC shows what? Unemployment, scarcity, obsolete technology, overutilization, this thing. Exactly, right? That is an easy one. A point on the PPC shows full employment. A point inside the PPC shows unemployment, right? So that is the answer, number 1, easy one. That is done. So we'll move on to the next paper. That is 2015. Okay. Now, most of the things will be things that we have discussed, right? So we'll go ahead with this. 2015. Which of the following is a microeconomic statement? Remember when we said microeconomics, it's about one small segment in the economy. What do you all think the answer is? 1, 2, 3, 4, 5. Microeconomics. Price of rubber. Give me a second. Okay. Price of rubber declined by 10%. Unemployment is 5.8, GDP, general price level, tax. So remember these concepts, right? Unemployment, you talk about unemployment of the entire country. When you talk about, let's say, GDP, that also you talk about the entire country again. When you talk about price level, that is also again entire country. When you talk about tax revenue, that is again a macroeconomic concept. So all of these are macroeconomic. But here can you see in answer number 1, right? You're only talking about the price of rubber. You're only talking about one single good. So one single good, you're focusing only on a firm, or you're only focusing on one single product. So that is a microeconomic statement. Then you have number 2. The 3 key groups of decision makers in an economic system, the key groups: households, businesses, banks, households, businesses, governments. The easy one again, right? Remember, there are three economic agents or decision makers in every economy. The main three people are households. They are the people who supply production factors, right, and who buy the goods. There are business firms. Business firms are the parties who buy production factors and produce goods. And then there is the government, right? This is a very easy question. Don't get that confused. It's number 2, right? That is the answer. Easy paper. Okay. Then this. What do y'all think this is? Opportunity cost of a particular activity. 1, 2, 3, 4, or 5. So remember, opportunity cost of a particular activity is the monetary cost and the foregone income. It's not just the foregone income, right? Because now y'all will understand this better when we do, I know some of y'all do come for my revision class, right? When we studied this, when we studied cost in economics, right? You all also would have done in your classes, right? When we studied cost in economics, monetary cost means the money that you pay, right? The direct money you pay, right? So remember in economics, right? When I said, right? Okay, this is connecting a little bit to unit number 4. In economics, right? In economics, when we say cost, right? When we say cost, we are talking about what? We're talking about the direct cost, right? Direct cost, in other words, that is the monetary cost, right? Monetary. And we are also talking about the indirect cost, right? That is only foregone income, foregone interest, and all of that. So in economics, cost means opportunity cost, right? Opportunity cost. So opportunity cost is a combination of what? It's a combination of your direct cost, in other words, your monetary cost, and also your indirect cost. That is your foregone income or everything else, right? So the answer here becomes number 2. Remember that. Opportunity cost is not only foregone income. Now, this is something that even while doing A levels, even I thought it was only foregone income. This is what I believed, right? But then I understood it's just not your foregone income, it is also the monetary cost. Okay, that is what opportunity cost is. Okay, then number 4. Okay, question number 4 says, okay, along a country's production possibility frontier, the level of technology is changing. More good of one goods can be produced without giving up. Resources are not being fully utilized. Available resources are fully utilized. There is production inefficiency. Remember when we talk about PPC, right? When we say if an economy is operating on the PPC, right? If they are on the PPC, what does that mean? Okay, so it's okay. If they are on the PPC, any point on the PPC, we say that this economy is employing its resources to the fullest. They have full employment of resources, right? So technology is changing. No, remember when we talk about PPC, we say technology is constant. So it is not this. More of one good can be produced without giving up producing another. No, if you are to go, when you're on the PPC, when you're going to another point, right? Let's say you want to go from this point to, let's say you want to go to this point, right? When you're going to this point, see, you have to give up one good to increase the production of one good. Let's say this is good X, this is good Y, right? Okay, my Y is bad. Okay, so if you are to increase the production of one good, you have to give up the production of another. So you can't. More of one good can be produced without giving up producing of another. No, you can't. So that is also not the answer. Then number 3, resources are not being fully utilized. No, if you're on the PPC, it means it's fully utilized. Wrong. Number 4 is the answer. Resources are being fully utilized. Production inefficiency. No, we'll talk about production efficiency. Production efficiency is where, right, the economy uses all their resources to the fullest and are operating on the PPC, right? So not number 5 as well. It's number 4 there. Okay. Okay. We have another question, number 5. If resources were perfectly substitutable in all economic activities, which of the following would be true? Output of all goods would be increased. Production possibility curve would be a straight line. Uh, Specialization and mutually beneficial trade would be impossible. No country or individual would have a comparative advantage. Scarcity of resources would be eliminated. What do you all think? Perfectly substitutable. That is one thing that we looked at. This, what has to click you is, we talked about this when we talked about constant opportunity cost, right? Constant opportunity cost. We looked at something, right? What were the reasons for constant opportunity cost? For constant opportunity cost, I said you have homogeneous resources. What does that mean? Homogeneous, right? I said the resources are homogeneous. Homogeneous means the resources are the exact same, right? The resource in one industry is the exact same for another industry. I can use this resource either to do this product, or I can use it to do the other product. So homogeneous resources meant, right, the resources are what? Perfectly substitutable. I can use this because it is the exact same resource, right? Homogeneous means the same resources between the two industries. Because the resources are homogeneous, that means it is the exact same. I can use these resources to produce any of the two goods I want. Let's say, now practically this is not a story, right? In practical context, there is no constant opportunity cost. We only have in what? Increasing opportunity cost. Okay, same question is given in 2012 paper. Okay, I can't remember that. Okay, so maybe exactly, that is my point. That is why I'm doing past papers with you all, right? Remember, same question will be repeated over and over again. So perfect substitutable means, right, if the resources are perfectly substitutable, one thing that you all have to remember is that it has constant opportunity cost. The answer would be number 2. Some of you all said number 5. Remember, right? Scarcity, right, of resources can never be eliminated. Now, even if your resources are perfectly substitutable, that does not mean there is no scarcity. You still have scarcity. You can use your resource either to produce this good or to produce that good. That does not mean scarcity is eliminated, right? There will be scarcity, right? So you can't say scarcity is eliminated. It's not number 5, right? For those who said number 5, so it's number 2 there. When you have perfectly substitutable resources, the PPC will be a straight line. In other words, homogeneous resources. The goods used in an industry can be used in the other production too, was the assumption. Okay. Okay, what is the point? Yes, so we assume that resources in that is that. Where does this connect to this part? No? Yep. Yeah, that was also an assumption. I agree. Fine. Okay, question number 6. Number 6 is economic based on capitalism includes all of the following characteristics except which one? What is a capitalist economic system? A capitalist, right? A capitalist. Okay, is a capitalist economic system and a market economic system the exact same? No, right? I'm hoping you all do know that. Nice. So a capitalist economic system is where the resources are owned, right? Owned by the private sector, right? Resources are owned by the private sector. You have, it's something like a market economy, but not exactly a market economy, right? So it will usually have the features of a market economy, a capitalist economy. Okay, so price based on demand and supply, yes. A system of private property, yes. Resources are owned by the private sector. Self-interest, definitely, right? They will not look at social welfare or anything. They will look at their own benefit. So self-interest, yes. Freedom of enterprise, definitely. You can go and do whatever you want. Freedom of enterprise means entrepreneurship, free entrepreneurship. If you want to start a business, you can go and start that business even today. No one is going to stop you, or no one is saying don't do that. Then number 5 is the answer. You will not have centralized planning, right? Centralized planning will happen in a socialist economy, or maybe a command economy, or you can say a planned economy. It will not be there in a capitalist economy or in capitalism, right? Okay, the question. So why the definition of opportunity cost indicates only the value of next best alternative? Why we don't talk about the direct cost in the definition? It's like this right now, because that's why I said there's a link to unit number 4 in that question. In unit number 1, when you talk about opportunity cost, you say it's directly the cost of the next best alternative. But if you really go right, we'll talk about opportunity cost in depth. Okay, it will talk about opportunity cost in depth when you study unit number 4. Just see whether when your teacher teaches you, right, opportunity cost, the teacher would say that cost in economics is opportunity cost, and it includes direct cost and indirect cost both. It's not just the indirect cost. We don't really touch that into deep in this. Okay, what's the difference between capitalist and a market economy? I'll talk about this when I do, let's say, part 2 question. There is a part 2 question on this, right? I'll do that. Okay, 7th one. Okay, this is an easy one. The degree of government involvement in an economy is greater in. Where do we have the greatest government involvement? Where is the government involvement the highest? Market, command, mixed, social, traditional. Okay, so if I am to give you government involvement, right, the lowest government involvement is in a market economy, right? Market economy has the lowest. Then you have a social market economy, right? A social market economy is also very similar to a market economy, but will have a bit of government involvement for, you know, social security and things like that. Then you would have a socialist. You have market, you have social market, you have socialist market economy, right? And then you have a command, or in other words, a planned economy, right? So that is where this one lies, right? So government intervention is the highest, right? So government intervention. So capitalist also you can put it somewhere near market economy, right? Government intervention, right? So government intervention increases as you go along, right? So let me put an arrow and show this, right? So then, okay, then you all wonder where is mixed economy. Okay, so government intervention increases as we go along this side, right? Market economy has the lowest government intervention. A planned economy has the highest government intervention. Social market economy and a socialist market economy, these two are types of what? Mixed economic systems. So a mixed economy, if you want to put mixed also, you have it in the middle. These are types of mixed economic systems. Difference between a social and a socialist, I'll talk about that. Let's see if you have a question in paper number 2. I'll talk about that then. Okay. Traditional economy is like an economic system where, you know, you have these veddas and people, right, where you have tribes and all of that. That is called a traditional economy. They won't question you on a traditional economy. Okay, so the government involvement is the highest in a command economy. If they ask where is the government involvement lowest, it is in the market economy. Okay, before moving to the next question, can you go to question 3? Okay, sure. So that is it with a liberal economy. A liberal economy is also like a market economy, something very, very similar. They will not go into that. Okay, question number 3. Where is question number 3? There was not much of explanation there. That's it. Okay, that part is done. So we are done with 2015. Right? So we'll move on to 2016. Right? 2016. Okay, again, now we start with liberalist and capitalist is somewhat the same. Guys, I'll give you all, once I finish this 2016, I'll give you all a 5-minute break. Okay. So this, right? Okay, the concept of scarcity in economics is a condition where, easy one. What is scarcity? Where do we have scarcity? Now, this was something again you had in 2020 A levels as well. Society is not utilizing all the available resources. That is not scarcity. People's wants can never be satisfied by low resource. Look correct. Some members of a society live in poverty. No, that is not what scarcity is. Too many frivolous goods and services are produced at the expense of social desirable goods and services. Not really. Production is efficient, but distribution is inefficient. No. What is scarcity? Scarcity is where you have, remember when I drew the diagram last class, I said there is limited resources, there is unlimited wants. As a result, you have something called scarcity. So scarcity is number 2, right? People's wants can never be satisfied by the available resources. Guys, I'm hoping you all have a book, right? Don't just have a fun time on your phone or on your laptop and staring at a screen, right? So I asked everyone at the very first class to maintain a CR book. Trust me, if you can maintain a CR book by the end of this program, once you see that CR book that you have done all the past papers, that would emotionally itself make you feel much better. It will make you feel very confident just seeing that book itself. Wow, I have done all these past papers and I'm good at it. So that is why please have a CR book, right? When I'm explaining questions. So I've told you all not to touch your past paper book. Don't scribble on your past paper book. Any workings, anything, write on your CR book, right? So have a 120 page maybe, right? So question, write the answer number. So if there is any explanation, write that explanation as well. Any way that you all can understand. Okay. What about the computer itself? If you mark in the PDF, yeah, you can do it on the PDF, no issues. But to what extent are you an expert on PDFs? If you're good at editing the PDF, I'm totally fine. But can you draw diagrams and all in that? If you're really good, yes, no issues at all. So my recommendation is to have a book, because if you have a book, then at the end you can see that and you will feel good about it. Trust me, you will. At the end, let's say at the end of 5 months, when you see a book saying, wow, I have done all the past papers, you will itself feel much more confident and you will really be able to get the exam done. Yeah, otherwise, because in case you write in papers, paper will be missing. If you, let's say, write in, let's say, in a past paper book, sometimes then later when you want to do past papers, you can't do, already answer is there. So don't write on your past paper book. Keep your past paper book blank towards the end. Let's say with 1 month to go, then write on the past paper book perfectly fine if you all want to. Okay, number 2, production possibility boundaries are drawn concave to the origin to reflect the, not reflects the, to reflect the what? To reflect what? Concave. Concave means this shape means concave or outward. Why do we have this? Guys, very simple thing, right? Concave PPC represents what? A concave PPC represents increasing opportunity cost, right? So it's this. Number 5, decreasing opportunity cost. The PPC would look like this. This is not practical at all. Scarcity, no. Constant opportunity cost, you will have a straight line PPC. Yeah, exactly. Convex. Unfair distribution resource, no. A PPC is concave to show the increasing opportunity cost, right? Questions are actually easy. It's not that hard. Okay, question number 3. In a free market economy, which of the following is incorrect? A market economy. Okay, so I'll just give you the basic features of a market economy, right? If you look at a market economy, right, what are the basic features? One thing that you have to know is there is private ownership of resources, right? All the land, labor, capital, entrepreneurship is owned by the private sector. That is what we call private ownership of resources, right? Resources. Then there is another point that says decisions are made based on price mechanism, right? So there is price mechanism here. Price mechanism, simple words, means all decisions, right, whether to produce this or whether to buy this, will be based on the price of that good, will be based on, let's say, the money that you can make, right? Things like that. So then you have this property rights. I'll talk about property rights maybe after this class in case there is a question. Is there a question here on property rights? No, right? Okay. So price mechanism, then the motive, you can say, is self-interest, right? People want their benefit. Producers want profit. Consumers want, we'll say, maximum satisfaction. The motive is self-interest. You have this private ownership. What else can you say? They can say high levels of competition, right? There is high levels of competition here, right? High levels of competition. You can say consumer sovereignty. Exactly, consumer sovereignty. right? Then you can say things like, okay, so individualism, consumer sovereignty, somewhat the same. Then you can say free entrepreneurship, right? So free enterprise. Okay, then you can say this, yeah, decentralized decision making, right? That is what, again, price mechanism, decentralized decision making. Okay, lack of public goods, yes, all of that is there. So those are like the basic features of a market economy. So if that is the case, what is the incorrect one? In a free market economy, which of the following is incorrect? What do you all think? Number one says prices allocate resources equally among competing production sectors in the economy. Decentralization making means anyone can make decisions. It is not by one person. Anyone can make a decision. Okay. Number two says price indicate relative scarcities and cost of production. Relative price changes are a determinant of a firm's profit and therefore encourage or discourage production. Prices are measures of consumers' willingness. Okay, prices signal to consumers how much they must sacrifice to obtain a commodity. Remember this. When we talk about a market economy, right? When things are done based on self-interest, when things are done based on price mechanism, one thing you all have to remember is that there is no, right, there is no equal distribution of resources. In other words, whatever goods that has been produced by this economy is not equally distributed. Remember when I explained the last question on the how to produce, when I said personal income, right? So there I said whoever who has the money is able to come and get the goods. So number one is the incorrect one. Prices allocate resources equally among production sectors. No, whatever production sector is, let's say whatever production sector is more profitable, you would go and allocate your resources there because you are motivated based on price, right? Let's say one industry is doing really bad, you will not allocate resources for that. For example, right, why does the public, in a market economy, when you study unit number 8, you all will see that in a market economy they don't allocate resources for a public good. The market economy does not allocate resources, for example, for, let's say, to produce street light, to produce, things like that. Yeah, so that does not really happen. So therefore you can't really say, right, that there is equal allocation of resources. Actually, there is not equal. You won't have equal allocation of resources. That is the answer. Answer number one. Audio is not connecting. Okay. I also can't remember what the settings. Yes, I'll give time to pray once I finish this. Okay, I said I'll give you a break. Okay. Screenshots of this I am not taking. If someone else is taking, please put on the group. I've opened the group for everyone. I open the group for everyone, guys. The reason why I lock the group where only admins can put a message is because sometimes when I put an important message, you all put a thumbs up, and that message, like, people are not able to read. That is why I have locked it for the other people, right? I lock it for others, not because I don't want you all texting, or not because of that, right? I just lock it because some students might miss an important message. Okay, so don't feel bad about that. What is price mechanism? I'll explain price mechanism, right? Maybe after this class. Yeah. Okay, number one. Okay, you have another question. In a competitive, okay, this is again, okay, am I? A competitive market with no externalities, allocative efficiency would exist if price equals what? Allocative efficiency is when price is equal to what? Total cost, marginal marginal cost, average variable cost, total value of marginal product. Okay, I'll give you all the simple understanding here, right? Some people must be wondering what nonsense is this, right? Allocative efficiency means, right? Don't go into deep in this as well. I'll just give you a basic understanding, right? Allocative efficiency, right? When we talk about allocative efficiency, what does allocative efficiency mean? Allocative efficiency means producing, right? Producing the goods that the society desires. In simple words, you are allocating your resources, right? Whatever resources that you have, you're allocating those resources to produce the goods what the society wants. Now you can have land, labor, capital, entrepreneurship. There is no point allocating your resources, let's say, to produce, let's say, I don't know, let's say guns or bullets or let's say those, no point. What the society wants, let's say society wants food, clothes, that is what they want. So you have to allocate your resources for those goods, not anything else, right? You have to allocate resources to produce the goods what the society wants. So society has two people. It has the consumers, right? Consumers, and it also has the producers, right? You have two parties in a society. So then, right, to figure this out in the consumer's point of view, right, the consumer would want to maximize his benefit, right? So he will be working on his marginal benefit. Now remember, how can you calculate a benefit for a good? There is no way of calculating a benefit for a good. No, how can I say I consumed, let's say, okay, okay, now some of you all are part of my revision class. You all are paying the monthly fee of 1,800, and then you all are coming for classes. So how are you going to say what is the benefit of this class for me? There is no way that you can say that is the benefit is this much. No, right? So usually to measure the benefit, right? To measure the benefit, we use the price. For example, if you're paying a 1,800 class fee, that means, right? If you're paying 1,800 class fee, that means you are getting a benefit worth 1,800. That is why you're paying 1,800. So for marginal benefit, you can substitute price. Okay, because my argument is that marginal benefit cannot be quantified. You can't give a number. You can't say I got this much of benefit. How do I say that you got this much of benefit? You say, okay, you giving a, let's say you're paying 1,800 as class fees, so you're assuming, or you're that it implies that you're getting a benefit worth 1,800. On the producer's point of view, you have the marginal cost, right? So if you remember, when we draw the curves, right, guys, you all should have some sort of understanding on this and this, and I'm hoping everyone does go to a class and has a basic understanding, right? So if I am to draw these curves, right, the marginal benefit curve and the marginal cost curve, the marginal benefit curve is downward sloping, right? You will have a curve like that. The marginal, okay, drawing straight lines is very hard, okay, marginal benefit, and you'll have the marginal cost, where the marginal, okay, where did my this one go? Okay, marginal benefit, and you have the marginal cost. The point where this meets, right, this is where this quantity, right, this quantity of x, that is where the society has to produce. Then you connect this to the PPC. I'm hoping you all remember allocative efficiency, right? You connect this line up, right? On this side also you will have a marginal cost and a marginal benefit. You connect this line, that, right? So this point is allocative efficiency, right? I hope you all remember that part. MC equals MR. Don't really go to marginal revenue in this case, right? We'll just keep it to marginal revenue. So I'll be talking about unit 4. Yes, MR and all is the MR equals MC. That is unit number 4, profit maximizing level, right? So in this unit, we'll only be looking at marginal benefit and the marginal cost, right? So in a competitive market with no externalities, okay, there was a question to explain externalities. Externalities is something you all will be studying in unit number 8, right? So don't worry about externalities too much. For now, just leave that. It's perfectly fine. That's an entirely new topic that you all will study in unit number 8, externalities, right? In a market economy with competitive market with no externalities, allocative efficiency would exist if price equals what? The price, right? So this is price should equal to the marginal cost. It should equal to this, right? So if the price is equal to the marginal cost, then you can say there is allocative efficiency. The answer will be number 3, right? I'm hoping, I know I didn't explain the whole theory behind this, but I'm hoping you all have some sort of understanding, right? So this, in simple terms, right, is your marginal cost curve. This is your marginal benefit curve, right? So where this intersects, where the marginal cost equals the marginal benefit, if you connect that, that is the quantity of the good that the consumer wants. So there is allocative efficiency when the marginal benefit is equal to the marginal cost. Another word for marginal benefit, or in other terms of let's say quantifying the marginal benefit, is the price. So if the price is equal to the marginal cost, then you can say there is allocative efficiency. Is that part okay? Yes, no? Questions? Yes, I'm hoping you all do have some sort of knowledge, right? Not a very blank student. Okay. Okay. This one. Question number 5. Human capital. The term human capital refers to what? Labor resource used to make capital, building machinery, skills and knowledge, entrepreneurship, labor force, right? Remember, guys, human capital means, right, the skills, the experience, right, the knowledge that the labor has. So how can you develop human capital? You can develop human capital by providing education, by providing training, by providing, let's say, what? Training and education. Let's say you can do things like job rotation, right? You can do things like that. What is human capital? It is the skills, it is the knowledge, it is the experience that people have. Yeah. So this favorable health. Yeah, if you want, you can take favorable health also. Okay. Number 4. If there's an answer as marginal benefit in all markets, can we take that? If this says marginal benefit, no, because price is anyway equal to marginal benefit. That's another way of measuring marginal benefit. If they say marginal benefit, no, the better answer would be marginal cost. Okay. Okay. Sixth one. Okay, easy one. Potential output. What is potential output? Potential output is the maximum GDP and economy actually achieved during the last 10 years, achieved during periods when all labor force is employed in tradable goods producing sector, a goal that can never be achieved, the GDP that could be produced when an economy's resources are fully employed at a normal intensity of utilization. Yes. So what is potential output right now? So for example, let's say when if someone comes and tells you your potential is much higher, right? Let's say, you know, you get, let's say you only score 50 marks for your exam, but your teacher says you can do much better, your potential is much more. What does potential mean? Potential means if you do your best, right, what you can achieve. So in other words, potential output means if an economy uses all its resources at its normal level, for example labor, now if you use it for 8 hours a day, right, if you use this at the normal intensity, remember, not the maximum intensity, right, if you use now, your potential output is represented by the PPC. Another way of representing your potential output is the PPC. A PPC represents the potential output of a country. It represents the maximum the economy can produce, right? The maximum of goods and services, in other words, the GDP that the economy can produce at normal intensity. Normal intensity means you can't overutilize your resource. Now, for example, labor, right? If you can make your usual labor works for how many hours a day? Let's say 8 or 9 hours a day. If let's say if you are making them work, let's say 16 hours a day, their maximum intensity can be, let's say, 16 hours a day. So then you can produce even outside the PPC, you can produce. But that is not really, but is that sustainable? No. Can you keep on using this labor for 16 hours a day every day? Can't. So potential output means the maximum you can produce at the normal intensity. If you use all the labor in the country and if you make sure those people, let's say, work 8 hours a day, what is the maximum you can produce? All your machines, that is what is represented by the PPC as well. Okay, so remember, potential output is number 4. The GDP that could be produced when the economy's resources were fully employed at a normal intensity of utilization, not maximum intensity. Okay, hoping that part is fine. Okay, so that's it with this paper, right? So since some of you all wanted a break to go pray and all, right, so I'll give you all a 5-minute break. This is 17. I will finish the entire paper only and finish the class. Sometimes it can go past 7, right? So take a 5-minute break, those who wanted to pray. It's 6:28. I will start, let's say, sharp at, let's say, 6:33. So take a break until 6:33 and then I'll start. Okay. So others also have some water run round. Okay. Right till 6:33. Yeah, I'll try to finish by 7. In case it goes, just please bear with me. Okay, so right, are y'all back? Yes. Can you all hear me? Are y'all back? Can you all let me know if y'all are back? So I can have a rough count. Can you just send in a message saying that y'all are back? So I have a rough count of how many came, how many are back, how many are not back. There's also, and make sure that because all this chat gets recorded as well, that at least once you all do a class, right, for like a free class like this, make sure you at least send in one message, right? So with your message also, your registration number and your thing is being recorded. Okay. Okay, coming to this 2017, which one of the following is not a factor of production? This is the easy one. You have four factors of production: land, labor, capital, entrepreneurship. Remember, in economics, money is not considered as a factor of production. Money is not capital. Why is money not capital? Money, what is capital in economics? In economics, we define capital as any man-made aid, right, that will help in the production process. Any man-made resource that is able to help in the production process, that will help to convert inputs into outputs. Does money help you to convert inputs into outputs? No. Money will not help you convert inputs into outputs. Money will help you buy capital. Money will help you buy the machine. The machine will help you convert inputs into outputs. Money is not capital in economics, right? Money is simply a medium of exchange. So that is not a factor of production. Easy one. Then again, okay, now same questions get repeated over and over again. Problem of scarcity exist only in developing economies, only in market economies between prices and services, exist now but will be eliminated in the future. No, it will not be eliminated in the future. Scarcity is always there, right? So scarcity, easy one, exists because of limited resource. In other words, another answer could have been exists because of unlimited wants, right? And limited resource, anything, right? So scarcity is because we have limited resources. Compared to our unlimited wants, we only have limited resources. If we had unlimited resources, then there will not be any scarcity. Okay, number two. Number three, which of the following is assumed when constructing a production possibility curve? In other words, they're asking what is the assumptions when you have a PPC, right? So what are the assumptions when you draw a PPC? You have, okay, so assumptions of PPC. What did we have? We say only two goods, right? Second, okay, produce only two goods. Then we say, what do we say? Then we say technology is constant. Technology is constant. What else do we say? We say the economy is using its resources to the fullest. There is full utilization or full employment of resources. Full utilization of resources, right? So we exactly, okay, specific time period. Right? Okay, so those are the assumptions that in simple terms, they're asking you one of the assumptions. Economy is using resources inefficiently. No, you say there is full utilization of resources. Yeah, resource stock remains constant. The quantity and the quality of stock is constant. Yes, that also, right? So economy uses resource inefficiently. No, they use it efficiently. Resource utilized produce only private goods. No, there is no assumption as such. Full employment, but not full production. No, there is full employment and full production both. Not this. Technology is fixed. That is, yes, that is an assumption. That is the answer, right? And then number 5 says there is no inflation. There is no assumption as such, right? We don't even talk about inflation when we talk about a PPC. So the assumption is production technology is fixed. Okay. Okay. So if someone wants to write the note down, okay, so you can say this. I'll add this as well. The quality, okay, that is the quantity, okay, quality and quantity of resources are constant. That is, in other words, your resource stock and the quality of those resources, in other words, the productivity of those resources are constant. Okay, so that is number 3. Okay, number 4. Give me a second. Okay, An economy has achieved productive efficiency when have they achieved productive efficiency? When they achieve productive efficiency, where are they in the PPC? They're operating at one point in the PPC. Okay, when the economy is at a PPC, right? What happens when they have achieved production efficiency? This is not allocative efficiency, this is production efficiency. Okay, so productive efficiency is where when you're operating on the PPC, when you're operating on the PPC, any point on the PPC, you say there is production efficiency. So then when you're on the PPC, what can't you do? It says it is unable to produce more of one good without producing less of another. That is correct, right? You can't produce. Now, let's say, remember I explained this before as well. If you want to produce more of another good, right? If you want to go from, let's say, this point to this point, if you want to increase the production of this good, right? You can't increase it without decreasing the production of another good. You have to decrease the production of this if you are to increase the production of this. So you are unable to produce more of one good without producing less of another. So one thing you have to know is when an economy has achieved production efficiency, you have to know when you have achieved production efficiency, you're operating on the PPC. When you're operating on the PPC, you can't increase the production of one good without producing the less of another, right? Then number two, marginal cost equals price. That is allocative efficiency, not production efficiency. Eliminated externality is no. Resources allocated to produce goods and services mostly wanted. That is allocative efficiency again. It is self-sufficient. No, there is nothing to that. Okay, question number 3 to take a screenshot. Yeah, right and thing in question number 3. Okay, this is question number 3. Yes, if someone has taken screenshots, can you put all the screenshots on the group? There are some people who are mistaking ones as well, right? I don't take screenshots, so it's up to you all. If you all want to help someone out with connection issues, please, maybe if you all are taking, just share it on the group, right? I've opened the group for everyone, so you all can send it. Okay, then you have this. Specific time period isn't an assumption. It is an assumption. We also talk about just one time period. We don't talk about, yes, when you draw a PPC. Okay, number 5. Recording of this, I will share it with the revision class students. I'm hoping there is no issue with the recording. Last class we had an issue with the revision class students. Yes, not with everyone. I can't be coordinating and handling Google Classrooms for everyone because it already with around 30 people, there is a huge people saying they didn't get added and this and that, having 250 people on a recording. And again, if I put a recording, because the class is free, none of you all will come. That is why I will not give recordings for this. For revision class, yes, I'll give you all. Yeah, no problem. Okay, fundamental economic questions of what to produce and for whom to produce are essentially interdependent. Why? What to produce means cannot send on the group. I took that away. No, just check on the group. Okay, sorry, only admins can send messages. Give me a second, I'll change that. So, okay, so everyone can send messages, just send the screenshots. Okay. Okay, this one. The fundamental economic question of what to produce and for whom to produce. What is this? What is what to produce and what is whom to produce? What to produce, right, is about where are you going to allocate your resources, right? In other words, it's your, right? What to produce means where to allocate resources. Where to allocate resources means you have land, labor, capital, entrepreneurship. Right now, where are you going to put this? Are you going to produce machines? Are you going to produce, let's say, food? Are you going to produce, let's say, clothes? Where are you going to allocate this resource? So where to allocate the resources, right? So then what is whom to produce? Now, whom to produce, remember I explained before, whom to produce means who gets the goods. In other words, who is going to buy this, right? So who gets the output? So they're asking you, why are these interdependent? What is the connection between this, right? So the answer is here. I think, okay, let me read. Different patterns of income distribution generate different patterns of demand. Therefore, different patterns of resource allocation. So that should be the answer. The answer here is number 1, right? Now, let me explain this answer. This is a little bit of a tricky question, right? You all will not get this at times. Right? Draw nicer circle. Drawing this nice circle is very hard. Mm, a second. Okay, so they say different patterns of income distribution. In other words, right, different patterns of income distribution means the whom to produce issue, right? Income distribution, who has different patterns of income. Some can have high amounts of income, some can have very low amount of income. Depending on their income, only they will demand for different types of goods. No, low income earners, they will assume for, let's say, smaller goods. Let's say high income earners, they will let's say demand for all these luxury types of goods. So based on their income only, right, you will decide what to produce, right? Let's say people have high income, then they will demand for, let's say, more luxury goods. So that is where this thing comes. Different patterns of income distribution generate different patterns of demand. You have different patterns of income distribution. Some people can earn very little, some people are middle class, some people are, let's say, high class. Based on that, they have different patterns of demand. So different patterns of demand, and therefore you have different patterns of resource allocation. If people are demanding these different goods, you have to allocate your resources differently, no? So that is why those two are interdependent. So this one says different production methods. Now production methods is not this, it is how to produce. That's why it is not the answer. Income and wealth are concentrated in hands of economically powerful segments. No, there is no connection there. Power markets cannot be relied upon to no. Particular level of activity, level of output may produce different combinations of inputs. No. Particular level of output can't produce different, maybe produced by different combination of input. Not really. They're only talking about what to produce here. They're not talking about whom to produce in this. Right? The answer is number one. This is a bit of a tricky question. If you all can understand, if you all are up to that level, I'm saying you all at a really, really good level in this unit. Okay. Is that part fine? Yes. Sep. Hoping that part is okay. Because I'm going a bit faster because I want to finish this. I'm not dragging the MCQs to another class. Okay. Okay. Main functions of prices in a market economy. Please do the questions and come. That only then it will make sense. Okay. So again, remember I taught you all about prices. There are, sorry, the functions. Informative, right? Or in other words, signaling. Then you had incentive, or another one was allocative or rationing. So they're asking which one of is the function. So if it has one of those three functions, that can be the answer. Generate more profits? No. Households choose investment opportunities, determine elasticity? No. Number 5, right? Allocate scarce resources among alternative users. This is the third function, the rationing function. Or in other words, remember I said, that is why I said, remember the other words, rationing in another word was allocative, right? So that is what they're asking there. It's the allocative function. Okay, 2017, done. Then going to 2018. Okay, 2018 question number 1. Which is the following? Okay, see again, common question, normative statement, positive statement. Which of the following statements is a normative statement? Increased fuel price will encourage demand. If income increases, luxury goods sales would fall. Laptop price increase, people will buy more. Government should control the rents of house owners charge. The quantity demand is inversely related. That's a very clear thing, right? Remember one trick of finding this thing, not always. A normative statement will have the words this, right? Normative statements have some keywords, right? Things like statements. Give me a second. So we'll have words like should. We'll have words like, let's say, ought, right? They'll have words like that. Usually in your context, you'll only have should, right? So it's number 4 there, right? So government should control the rents of household. You can say they should. I can say they should not. So that can be the story. Should bad? Not very sure. So it's in simple terms, remember normative statements, yes, may, those also are things, yeah. So it's a judgment, it's a personal judgment. It's not something that you can control. Now government should control the rents of household owners. Can you control whether they should or cannot? Can you prove whether they should or not? No, you can't really this thing. Okay, why isn't 3 a normative statement? Number 3, if laptop prices fall, people will buy more of them. That you can prove, no? If laptop price fall, you can prove whether people will buy more or less. So that is not the case. So that is why it's not number 3, right? So that is the thing. Okay, hoping that part is okay. Then you have number 4. Okay, another easy one. I think there was a question like this before as well. Which of the following is an example of land as a factor of production? Harbor, expressway, dam, dairy farm, beach. Which one? Land. Think carefully. Land should be natural resources. Nothing. There should not be any human intervention, right? So harbor, will it just come? No. A harbor you have to produce. So harbor is not land. Harbor is capital, right? Expressway, again capital. Dam, will a dam just come? No. You have to build a dam, right? So no. Dairy farm will not just come. It is also this. It's Pasiguda beach. That is the answer, right? Number 5. All the other 4 are capital. Human intervention. Dam will not just come, you have to build a dam. Expressway will not just come, you have to build. Farm also you have to build. The Pasiguda beach, which is the land. Okay. Okay, then question number 3. Number 3 says, which of the following is always true? Okay, again, same thing, right? Now, this is something that we did the previous year also. Which of the following is always true in economy operating on the PPC? So, economy operating on the PPC, what did I say? If you're operating on the PPC, you have what? You have full employment of resources. So your resources are fully employed. It's number 3. That is what that means. Easy one, right? PPC. See, same questions now you get repeated again and again and again. Why if income rises, then the sale of luxury goods fall? If income rises, sale of luxury goods will increase. It will not fall. Okay, number 4. So on a diagram of a production possibility frontier, opportunity cost is represented by, how do you calculate opportunity cost on a PPC? Slope, point inside, ray through the origin, point on the vertical axis, point on the horizontal axis. How do you find opportunity cost, guys? Right, if you have a PPC, right, say you have a PPC like this, right? So if you are to find, let's say these are the 2 points, you're going from this point to this point, how do you find opportunity cost? Your decreasing units divided by your increasing units. In other words, it's your this one divided by this one. It is your slope that you're talking about, right? So the PPC, right? Opportunity cost is represented by the slope. So in other words, if the opportunity cost is constant, you have a constant slope. If the opportunity cost is increasing, you have a slope like this. If you have decreasing opportunity cost, you have a slope like this, right? So the opportunity cost is represented by the slope of the PPC. Question number 3. What about question number 3? Anything that I missed? I did the question number 3, right? Okay. Okay, so that is that. Okay, which of the following is necessary for a well-functioning capitalist economy, but not in a command economy? What do you think? Centralized decision making, scarcity, monopolies, protection of property rights, and positive externality. What do you need in a capitalist but not in a command? Remember, okay, number 4, the answer is number 1. Okay, so for this, remember what is, okay, now I'm coming to this. Someone asked me what property rights is. Property right means, right, the right. Property rights in simple terms is the right to use, the right to sell, or right to get a return from an asset, right? For example, so it is the right to use, let's say sell, let's say get a return at anything from an asset. So if you have the right, right, if you have the right, that means you own that. Now remember, now you are living in a house, right? You are living in a house. How do you know that house is yours? How are you able to use that house, all of that? Because you have something called the deed for the house. No, house has a deed. You can say this house is mine. So who gives you the deed? It's the government who gives you the deed, right? Now in a capitalist economy or in a market economy, we are saying there is no government. Everything is run by the private sector. So then you have a problem. Who is going to tell you that this is mine, right? So there is a big story behind this, right? I think I explained this in my revision class as well. I'm hoping your classes also did. So for a market economy or a capitalist economy to function well, you have to have these property rights. You have to make sure that people are able to claim these resources. Now, for example, if I start a business, right, I will only start a business if I get the property right for it. If I can say that this is my business, because otherwise someone else can come tomorrow and say, this is my business, I need the profit. So for a capitalist economy to well function, you should have proper property rights. You have to protect the property rights. That is the answer there for number 5. Protection of property rights for a capitalist economy. Okay, this goes a little bit of deep than your general knowledge. If you all are in that level, again, very good. Okay, this. Okay, again, same question repeated. When a firm is producing the allocative efficient level of output, total revenue is equal to total cost, marginal revenue equals marginal revenue is greater than marginal cost, price is equal to average total cost, price is equal to marginal cost. What did I say? I said marginal benefit is equal to marginal cost. I said another word for marginal benefit. In other words, to quantify the marginal benefit, you can use price. So it's number 5. Remember, some of you all will put number 3, right? Number 3 is something that is not allocative efficient. Number 3, marginal revenue equals marginal cost. Is there something like that? No. Okay, there is no. Okay, marginal revenue, number 2, marginal revenue equals marginal cost. This is not allocative. This is the profit maximizing level in a perfect competition, right? MR equals MC. Don't confuse that with allocative efficiency. Okay, some of you all, you all know too much. Try to confuse that. So that's not that. Okay, that question is done. Okay, next paper. Okay, now if you all figure out, you all will see. Okay, how many of you all did this? 2019, the old syllabus paper. The syllabus changed in 2019. I don't know how many of you all did this in your past paper book. Usually, they'll only give you the new syllabus paper. They will not give you the old syllabus paper. As this is the old syllabus paper, just go through. The PDF document is there. Remember, I asked you all to. I sent the past papers. I put it into a Google Drive link and sent the past papers. In that past papers, this 2019 old paper is there. Okay, I'll just go through this as well because I don't want to miss any paper. 2020, actually, I didn't find the old syllabus paper. I only had students writing the new one, so I only have the new one. Once it's out in the internet, I'll find and send. Okay, central problem of economics. What is the central problem of economics, guys? Central problem of economics is scarcity. Why do we have scarcity? To establish democratical political, no. Establish prices, no. Scarcity of productive resources relative to human bonds. That is what the central problem of economics is. Economics central problem is scarcity, number 3. Okay. So then you have this. Okay, question number 2. Again, see, now same questions being repeated, right? Human capital. What is human capital? Human capital is the skills and the knowledge endowment of the workforce. Remember, when you all do your paper, trust me, same questions will only come. That is why I'm doing past papers, right? So please go through these very, very carefully. Question number 3. See again, see same questions, right? Now, I don't know, whoever who wrote this paper would have been very lucky. Productive efficiency is what? Productive efficiency means the use of least cost techniques of production of product mix, full employment, production at some point inside of the production possibility curve, at a technological improvement substituting labor with capital. Productive efficiency, least cost techniques of production. You can even say that. Okay, we'll go for number 3, full employment of all labor is not just full employment. You can even say there is full production also. Answer for question number 2. Answer for question number 2 is 4. The human capital, right? The same thing that I did. That's why I went faster. Okay. This question. What do you all think? Why can't it be number 1? Can it be number 1 as well? Production efficiency. 1 or 3? How sure are you? Sure? It's not 3. It's 1. Production efficiency, right? Remember carefully. Production efficiency, you have 2 conditions for production efficiency. For production efficiency, what are the 2 conditions, guys? Anyone? Production efficiency? You have 2 conditions to achieve production efficiency. Okay, one is full employment. What is the other one? Full employment. Exactly. full employment and the full production, right? So it's not just full employment. If you, most of y'all, right, almost 99%, not 99%, 100% of y'all, all of y'all told me number three. It's not number three, right? Production efficiency implies that full, not just full employment. It's not only full employment. You should have full employment and full production as well. Now, when you have production efficiency, right, if you are employing all your resources and if you're getting the maximum use of it, full employment and full production, if you're getting the maximum use of it, remember, you are able to produce in the most efficient way. You are able to produce at the lowest cost, right? When you have production efficiency, remember that when you have achieved full employment, when you have achieved full production, if you have achieved all those two together, you have production efficiency. In other words, that also means that you are able to use the least techniques, least cost techniques. Remember, number three is wrong because number three only talks about full employment. It's not full employment, it's full employment plus full production. If this had full employment and full production, then I can give that as an answer, but we go with number one, the least cost techniques of production. So point to learn, remember that. Okay, moving on. Okay, question number 4. Okay, as productive resources are scarce, it needs to give up some amount of one good in order to acquire more of another. This is the essence of the concept of what? Specialization, implicit cost, comparative advantage, absolute advantage, opportunity cost. Too easy, right? Giving up one good to get another. We're talking about what? We're talking about opportunity cost. Number 5. That is the answer. Okay, question number 5. Okay, by which of the following can economic growth be depicted using a PPC or a PPF? How do you show economic growth? When the economy grows, what happens? The PPC will shift outward. How do you show economic growth? When there's economic growth means that the economy has now more land, labor, capital, entrepreneur. They're able to produce more goods and services. So economic growth is shown by a rightward shift of the PPF, right? Simple question there. Okay, we have 6. Okay. The idea that consumers determine what is produced in the economy through their demand is known as what? Consumer decides what to produce. A laissez-faire economy, market economy, consumer sovereignty, free enterprise, mixed economy. What do you call it? When the consumer has power, when the consumer can determine what goods to be produced, we call that, remember, we call that consumer sovereignty. Yes, consumer sovereignty is there in a market economy, but that is not what they're asking. They're asking you, they are not asking where it is there. They're asking, it is known as what? It is known as consumer sovereignty. Answer number 3. Okay, that is that. Okay, is there more questions? No. Okay, so then we move on to 2019. We have 2 more papers, right? The questions are very much similar. What is the time? 7:01. I should be able to finish, let's say, another 10 minutes, maximum 5 minutes. I'll finish in another 5 minutes. If you want, you can leave. No issues. I'm not holding you, because I don't want to stop this and do a part of this next class. Okay, branch of economics that studies individual households and firms. Easy one. Studies individual households and firms. Microeconomics, right? Hoping that you all know. Question number 2. Okay, income payments made for resource owners: land, labor, capital, entrepreneurship. For land, what do you pay? You pay rent. For labor, you pay wages. For capital, you pay interest. For entrepreneurship, you pay profit. Can you see that questions are getting easier now? Yes. Why are the questions getting easier now? Questions are getting easier because you have done the previous question. It is not that this 2020 paper was easy. It's because you all did from 2011 onwards. Now it's easy. Same question they're asking over and over again. Which of the following is a salient feature of a command economic system? Command economic system. This is 2019 new syllabus. So command economic system, what do we have? We have what? We have centralized planning. It's the opposite of a market economic system. Private ownership, market economy. Heavy reliance on markets, again market. Concentration, market power, market economy. Self-interest, market economy. Centralized planning is there in a command economic system. Okay. Okay, give me a second. Okay, this one. Okay, remember I taught you all how to. Okay, second question again. I'll explain that. Give me a second. I'll come to this. The diagram below shows PPF of an economy producing at point A. Remember I told you all how to calculate uh, opportunity cost. What is the quantity of good X given up to produce the quantity of good Y? How much of good Y are you producing? You're producing 800 of good Y. To produce 800 of good Y, how much of good X can't you produce? To produce this much, you are giving up this much of good X, no? So you have given up. Remember, I think I explained how to read these graphs. So the opportunity cost of producing uh, 800 of good good Y is 200 units of good X. That is the answer, right? Okay, only 4 questions. Okay, question 2, someone wanted, what is there in question 2? This is basic theory. There is no explanation, right? The factor payments. If you give land as a factor of production, the return you get is rent. If you give labor, you get a return called wages. If you give capital, the return you call it as interest. If you give entrepreneurship, the return is called profit. Right? There is no explanation. That is just a theory part that they ask. Okay. Last question. Okay, last question. Okay, fourth one. I think I explained this last class as well. So since some people are in a hurry to go, after this class, I'll explain this to you, right? If you are in doubt of that. Okay, once I've finished it, so then the people who wanted to go could have gone. There are people already gone, but I'll finish this and then send you all off. Okay. 2020, the new paper, right? The paper is not that clear, but we'll just go through. Free good, which are the following characteristics? Now, if you've done all the papers, trust me, this paper will be easy. It will be nothing. Free good, what is the answer? Some degree of scarcity, it has no opportunity cost. Consumption and production, there is an externality supplied free of charge. Supplied by the government? No. Supplied by the government itself? Because no. So what is a free good? Free good, what are the examples? Examples like sunlight, air, things like that, right? So a free good, what is the characteristic? It has no opportunity cost in supply. There is no opportunity cost. Then the next question. Economists refer to the term capital. What is capital? Capital are man-made resources that are used in the production of goods and services, right? So which one talks about this? Number 1. Yeah. So easy questions, right? Now these are not hard questions that is going on now. So then 2000. Okay, what is meant by the statement every economy faces the problem of scarcity? In other words, they're asking what is scarcity? What is scarcity? So exclusively, I'll come to that. So this one. So statement, every economy faces scarcity means the productive resources are not sufficient to satisfy all the wants. See, same question, right? Now they'd have nothing else to check. They're asking the same thing over and over again. And number 5. Okay. Again, easy one. Allocative efficient point on a PPF curve is achieved where? When do you have allocative efficiency? When the what? When the marginal benefit equals the marginal cost, right? Or you can say price equals marginal cost or anything. So it's number 2. So if you had done your past papers, right? If a student for 2020, if that person has done the past papers and gone, can you see how easy these MCQs would have been? 2020, you had only 4 MCQs from unit number 1. You have easily scored this 4 without even thinking anything, right? So it is that easy. That is why I'm doing the papers. Please have attendance come, right? We'll do that. Yes, guys, if you want to leave, you all can leave, right? So thank you for coming today. I'll see you all again on next Wednesday. Next Wednesday, I want you all to do all the part 2 questions and come, right? I will be discussing the part 2 essay questions in unit number 1. After that, I will start unit number 2. Then I will add there are people in the pending list who want to add. So I'll add them there. 3 answer is number 4. Okay. Wait. Exclusively was in this question. Okay. The economics refer the term exclusively. So exclusive, you don't have to think too much about this word. In simple terms, exclusively means what is that? So what is capital? What is the definition? Right? That is what exclusively here means. Okay, give me a second. I'll stop the recording so then these questions will not be there. Yeah, see you guys. Welcome.